What's up guys, Ben here and welcome to Motivation to Invest. Cathie Wood runs ARK Invest, an investment firm which specialises in disruptive and innovative technology. She's widely regarded as one of the biggest Tesla bulls and predicted that stock to reach $5,000 per share. So what has she been buying right now? Well, in this video we're going to find out, as she has been investing heavily into a major Chinese growth stock. And with US stock prices at extremely high valuations, investing in China could be a great option for many of you guys. Despite the trade tensions, China is a country which has the second largest economy and the world's largest population of over 1.4 billion people. So diving into the latest trades for ARK Invest, we can see coming in at number 2, there's been a major buy order for Douyu, ticker symbol DOYU. ARK Invest have purchased 451,068 shares, which make up 0.645% of their ETF. They've also been buying heavily in Fastly stock, Fastly ticker symbol FSLY. They've purchased 87,200 shares just that day at 0.2537. This was on the 16th of October. Now, I did a video on Fastly. Their stock plummeted by around 30%, and I did an amazing overview of that to say whether that is a good opportunity to buy right now. I believe the stock is still down, so be sure to check out that video. Be sure you understand the risks involved in the whole company before you decide to invest into it. But in this video, we're going to be diving into this Douyu International Holdings. So what is Douyu and what do they do? Well, Douyu, headquartered in Wuhan, China, a popular place recently, is a leading game-centric live streaming platform in China and pioneer in the esports value chain. Douyu operates its platform on both PC and mobile apps, through which users can enjoy immersive and interactive games and entertaining live streaming. Douyu's platform brings together a deep pool of top live streamers by providing a sustainable streamer development system built on advanced technology, infrastructure, and capabilities. Douyu helps to ensure consistent supply of quality content through collaborations with a variety of participants in the esports value chain. The company has gained coveted access to a wide variety of premium esports content, which further attracts viewers and enhances user experience. And you may be saying, Ben, is esports a real thing? Do people actually do these online gaming sports competitions and live streaming? Like, why would someone watch someone playing a game? But it turns out these industries are massive growth categories. So the esports market revenue worldwide from 2018 to 2023, we can see here it was $776 million in 2018, and that has risen to $950 million in 2020. This is predicted to reach $1.5 billion in 2023. So the esports industry is expecting to grow rapidly in the coming years. The majority of these revenues come from sponsorships and advertising, and the rest from media rights, publisher fees, merchandise, tickets, digital, and streaming. In terms of revenues, Asia and North America represent the two largest esports market, with China alone accounting for almost 1/5 of the market. So the major player in this industry is Douyu. You may be thinking, Ben, what's the competition? What are the other players in this industry? Well, there is one more company which is very interesting, and I did a full analysis of this a while back. This company is called Huya, and that company, in their own words, is the number one live streaming platform in China. They also plan to become the most popular technologically enabled entertainment community for the younger generations in China. They have the largest and most active game live streaming community, rich and dynamic content, cutting-edge technology. And they have great numbers. They have great growth rates on their revenues. They have a great balance sheet. Fantastic company. I did invest in these a while back. Full disclosure there for you guys. Well, it turns out Huya and Douyu are doing a merger. So you get the best of both worlds in one single company. This was announced on the 12th of October 2020, so very recently. They will form a new company with limited liability, incorporated under the laws of the Cayman Islands. So the real winner of this agreement is Tencent, which is a technological mammoth in China. So that company actually has shares in both Huya and Douyu. So they're going to be really benefiting from this merger. But what about the numbers of Douyu? Let's dive into those. So here we are, guys. We're on Stockopedia. For those of you guys that don't know, Stockopedia is the platform I use to analyze stocks. I use this all the time for almost all the videos on my channel. I find it so helpful. Each stock's given a stock rank and it allows you to quickly analyze stocks. Instead of reading from a 500-page investor presentation, this will extract a lot of the relevant numbers out and put them in a nice user interface which allows you to quickly analyze them. If you guys wish to check it out and see if it fits your investing style, I've actually got an exclusive 25% off discount link you can check out. If you sign up, you'll get 25% off. This is exclusive only for you guys, the viewers of Motivation to Invest. So be sure to check that out. I'm not sure how long they're going to keep running this offer for. So yeah, feel free, sign up, take advantage of it while you still can. Douyu International Holdings, it's a technology, adventurous, large cap, high flyer. Now the momentum is 83. Now that's a very high momentum score, and that's because it's at the convergence of three major growth technologies. So the three major growth catalysts, you've got the growing esports market, you've got the growing gaming market, and you've got the growing live streaming market. So Douyu takes advantage of that. Oh, and there's one more as well, the growing Chinese middle class population market. So Douyu really does take advantage of all those growing markets. A value of 29, quality of 81. So diving into the share price for Douyu International, we can see it was around $7 a share in April 2020. It shot up by over 131% in August, and then it's corrected slightly down. It's only up 100% now, and the share price is around $15 per share. But what makes this company so special? Well, the growth rate on the revenue is extremely, extremely high. Probably one of the highest I've ever seen on this channel. So usually I say a growth rate for a company on the revenue, 20, 30% is good. 40% is really good. 50% is extremely good. 70% is tremendous. This is 110%, guys. Compound annual growth rate on the revenue. Now that is extremely good. That's crazy. That's the average over the past few years. However, there's always a negative to this. So I'm assuming this company was reinvesting a lot of their profits to get this major growth. So their profits were suffering. They suffered a loss in the past few years. But at the moment, year to date, they are in profit and they are predicted to be net profitable these next few years, which is a great sign to see. So the revenue is forecast to increase there. This is in Chinese yuan, I believe. So it's 10 billion yuan and it took up to 12.4 billion yuan. Net income also forecast to increase, and is earnings per share. So these are all great signs to see. When these arrows are basically in the top right, that's great. That's great. That's what you want to be looking for. Analyst consensus, free hold, free buy to a strong buy. So very bullish analysts who cover this security. Current ratio 4.61. So it's a fantastic balance sheet. Generally, I look for a current ratio of at least 2. Means the company can pay off its short-term debts at least twice with the available cash on hand. Short-term debts are those due within 1 year. 4.61, fantastic balance sheet. A lot of cash on the books to keep investing. Price to book 4.34. So that says it's great compared to the industry in terms of value. P ratio 22.4. Now, the reason a lot of these Chinese companies are getting very interesting right now is because the price to earnings ratio, despite its major growth, if this was a US stock, trust me, that PE ratio would be through the roof. It would be 80, 90, 100. The average, I believe, for the S&P 500 at the moment is around 28, and that's not including all growth stocks. So PE ratio for 22.4 for a major growth player like this is fantastic. But there are risks with investing into China. Of course, you've got trade tensions between the US and China, so expect major volatility. Also, my second point is that many of these Chinese companies are known for being quite, how can I say, creative when it comes to their accounting. Some of the numbers tend to be inflated on certain companies. I'm not painting all of them with the same brush, but this can be really risky for certain investors. Generally, it's the smaller companies, and if it can actually get to a point where they can be removed from stock exchanges. Now, that's just something to be aware of. It doesn't happen for all the companies, usually the smaller ones, like I say, but it is just something to be aware of. They're not held to as high of a standard as a lot of the US companies are in terms of their accounting. So what are your thoughts on investing into China, investing into Douyu, and investing into Huya? Let me know in the comments below and I'll join in the discussion. And if you guys found some value in this video, feel free to give it a big thumbs up. That really helps out with the YouTube algorithm. And if you want more investment tips and exclusive stock market picks, which I'm personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I'll see you guys in the next video. Invest safe.